We're in a moment where growth looks strong on the surface. GDP is holding up. Inflation is cooling gradually. Productivity is improving. And yet, beneath that surface strength, markets are starting to look fragile. That tension is what matters. The prevailing narrative says we can have solid growth, declining inflation, and stable markets all at once. AI productivity is expanding output. Fiscal policy is turning less restrictive. Credit conditions are not tight enough to force contraction. On paper, that combination looks constructive. But markets do not move on paper. They move on internal pressure. AI productivity lowers unit labor costs. That can help inflation drift lower. But at the same time, competition compresses margins. When margins compress in the most concentrated names, valuation risk increases. And when leadership stops carry the index, concentration becomes fragility. If a handful of large companies correct meaningfully, wealth effects begin to matter. The upper income cohort drives discretionary services spending, travel, leisure, experiences. When asset values soften, spending follows. That is how a market correction can influence growth without an immediate recession. The labor market is another hinge. Break-even hiring is relatively low. We are still above that threshold, but not by a wide margin. If hiring slips below break-even for sustained periods, pressure builds quietly before it becomes obvious. Credit spreads are the transmission channel to watch. As long as spreads remain contained, stress is isolated. If spreads widen materially, financing tightens and risk transitions from market volatility to economic slowdown. Before we go further, a quick note. This is educational commentary on macro signals, not investment advice. The broader framework here is simple. Policy can delay stress, but it cannot eliminate structural imbalances. Liquidity can override fundamentals temporarily, but not permanently. Right now, we are likely in a late-cycle delay phase. Growth persists, inflation drifts, markets rotate, but internal volatility increases beneath headline stability. If you find this kind of signal-driven analysis helpful, consider subscribing. The goal here is to help you think in probabilities instead of predictions, to understand mechanisms instead of reacting to headlines, and to stay positioned with awareness rather than emotion. What would shift this environment into something more serious? A sustained widening in credit spreads, hiring falling below replacement levels, liquidity tightening without coordination, or a sharp compression in equity multiples that spills into spending. What would invalidate fragility concerns? Improving breadth, stable margins alongside productivity gains, credit markets staying calm despite equity volatility, and labor participation rising without unemployment accelerating. The key distinction is delay versus resolution. We do not need to forecast collapse. We need to monitor transition. Growth can remain solid for a time. Inflation can drift lower. Markets can even rally further. But when strength and fragility coexist, risk is no longer about timing. It is about sequencing. And in late-cycle environments, sequencing is everything.